They told you that your home is your biggest asset. They told you that as long as the price goes up, you're winning. But if you actually sit down and do the math, you'll realize that for most people, their home is actually a financial black hole. Welcome back to the FinRadius USA. Today, we are deconstructing the housing trap. I'm going to show you why a $500,000 house can actually make you poorer over 30 years than if you never bought it at all. Most experts ignore the hidden math of maintenance, property taxes, and the silent killer, opportunity cost. I've run the numbers for 2026, and the results are shocking. If you think your equity is safe money, you are falling for the oldest trick in the bank's playbook. By the end of this video, you'll see the exact math of loss behind homeownership and the 3 things you must do if you don't want your house to eat your retirement. If you want to protect your labor value and insulate your family's future, subscribe right now and hit the bell. Let's begin by defining what an asset actually is in strict corporate accounting terms. An asset puts positive cash flow into your pocket every month without requiring manual labor. A liability takes cash flow AUT of your pocket every month, regardless of whether you are employed. Under this unyielding mathematical definition, your primary residence is not an asset. It is a colossal liability. Every 30 days, your house demands mortgage principal, mortgage interest, property taxes, homeowners insurance, and HOA fees. If you stop paying those liabilities for 90 days, the state or the bank will seize the property immediately. You do not own the property outright. You own a leveraged equity contract while paying rent to the government via property tax. Now let's calculate the brutal math of loss on a $500,000 home over a 30-year horizon. Assume you buy a $500,000 house with 20% down, putting $100,000 of liquid cash into drywall. You take out a $400,000 mortgage at a standard 2026 interest rate of 6.8%. Your monthly principal and interest payment is approximately $2,607. Over 30 years, you will pay the bank over $538,000 just in interest charges. In the first 10 years of your mortgage, nearly 75% of every monthly check goes directly to bank profit. You are essentially renting money from the bank while bearing 100% of the structural maintenance risk. But mortgage interest is only the first layer of unrecoverable capital bleed. Layer 2, compounding property taxes and insurance premiums. At an average national property tax rate of 1.2%, you pay $6,000 every single year. Over 30 years, accounting for local tax assessments and inflation, you will pay over $250,000 in property taxes. Add homeowners insurance at $2,000 annually, compounding upward due to climate and replacement costs. That adds another $80,000 to $100,000 of completely unrecoverable, non-equity friction. Layer 3, structural capital expenditures and maintenance decay. Real estate professionals apply the 1% rule. A home requires 1% to 2% of its value annually in maintenance. Over 30 years, a house requires 2 new roofs, 3 HVAC replacements, new plumbing, electrical upgrades, and appliances. That is easily another $180,000 spent simply preventing the structure from rotting into ground. Let's add up the true 30-year cost of that safe $500,000 home. Purchase price, $500,000. Mortgage interest, $538,000. Property taxes, $250,000. Insurance, $90,000. Maintenance, $180,000. Total capital extracted from your life, over $1.5 million. Now, real estate brokers will tell you, yes, but your home will appreciate to $1 million over 30 years. Let's test that claim. Even if your $500,000 home appreciates to $1 million, you spent $1.5 million to get it. You have a net nominal loss of over $500,000 in unrecoverable carrying costs. And that does not even factor in the single most destructive wealth destroyer in finance, opportunity cost. What is opportunity cost? It is the immense compounding wealth you sacrificed by locking capital into illiquid drywall. Consider your initial $100,000 down payment and the monthly carrying cost premium over rent. If that $100,000 were deployed into a broad market S&P 500 index compounding at an historical 10%, that single $100 K down payment grows into over $1.7 million, completely hands-free over 30 years. That is $1.7 million in pure, liquid, dividend-producing wealth with zero property taxes and zero roof replacements. If you add the monthly difference between renting and the true total carrying cost of owning into that index, the renter accumulates over $3 million in liquid capital while the homeowner is trapped with an illiquid house. Dr. Evelyn Vance analyzes the historical real return of U.S. residential real estate over the last century. Nobel laureate Robert Shiller's century-long data proves that inflation-adjusted residential real estate appreciates at barely 1% annually. A primary home barely beats inflation over a century. All apparent gains are driven by currency debasement and leverage. Furthermore, home equity creates the dangerous psychological condition known as house rich, cash poor. You have $500,000 in equity locked inside your walls, but you cannot use a brick to buy groceries or pay medical bills. To access that equity, you must either sell the house, pay 6% broker commissions, and pay moving costs, or take out a home equity line of credit at 9% interest, going deeper into debt to borrow your own money. This is the ultimate bank trap. The bank locks your cash in drywall, then charges you 9% to access your own savings. If you are finding actionable clarity in this quantitative breakdown on the FinRadius USA, take a moment to subscribe, like this video, and hit the notification bell so you never miss a deep dive analysis. Leave a comment below with your monthly carrying cost. We read and analyze every single response. Now, let's reveal the 3 non-negotiable rules to insulate your wealth from the housing trap in 2026. Rule 1. Reframe your primary home strictly as lifestyle consumption, never as an investment. Buy a house because you desire the school district, stability, or personal space, not because you expect it to fund your retirement. When you treat housing as an expense, you buy the minimum space you need rather than stretching your budget to the absolute limit. You protect your monthly cash flow margin so it can be deployed into real productive assets that actually generate cash. Rule 2. Master the rent versus buy arbitrage equation. In many metropolitan markets in 2026, renting the exact same home is 30 to 40% cheaper than owning it. If your total monthly owning cost, mortgage, tax, insurance, maintenance, exceeds rent by $1,000, rent the home. Invest that $1,000 difference into total market index equities and capture the compounding spread. The landlord covers the property taxes, the landlord pays for the broken water heater, and you retain complete capital liquidity. Rule 3. Separate your living space from your real estate investments. If you want real estate exposure in your portfolio, acquire cash-flowing multifamily assets or commercial property. An investment property generates positive monthly rent, provides commercial tax depreciation, and uses tenants to service debt. A primary residence provides none of these benefits. It only extracts cash from your daily labor. Alternatively, utilize house hacking strategies. Buy a duplex or build an accessory dwelling unit to offset carrying costs. Having a tenant cover 70% of your mortgage payment neutralizes the housing trap immediately. Now let's examine the 4 hard asset pillars recommended by the FinRadius USA to redeploy your freed capital. Pillar 1. Broad market equity ownership in productive global corporations. Index funds provide liquid, self-clearing ownership in thousands of cash-flowing businesses that scale with GDP growth. Pillar 2. Physical monetary gold and precious metals stored in private non-custodial custody. Gold carries 0 property taxes, 0 maintenance decay, and has preserved purchasing power across 5 millennia. Pillar 3. Digital scarcity via Bitcoin and decentralized protocol networks. Bitcoin provides uncensorable, mathematically capped capital mobility with 0 municipal property tax friction. Pillar 4. Cash-flowing commercial and agricultural real estate assets. Real estate that generates true external revenue, rather than draining your personal paycheck every single month. Julian structures his capital across all 4 pillars to achieve complete sovereign independence. Escaping the housing trap requires a radical psychological shift, decoupling shelter from your investment identity. Your home is a place to live, raise a family, and create memories. It is not a retirement plan. When you stop expecting your house to make you rich, you make rational, mathematical financial choices. You stop over-leveraging your net worth into a single illiquid physical asset in a single geographic coordinate. Here is the final execution checklist from the research team at the FinRadius USA. Checkpoint 1. Calculate your true total monthly carrying costs, including maintenance and tax friction. Checkpoint 2. Execute the rent versus buy arbitrage math for your local market before signing a 30-year mortgage. Checkpoint 3. Direct all freed capital margin into liquid, yield-bearing hard assets that compound automatically. Take audit of your balance sheet tonight and reclaim your labor value from the real estate illusion. Subscribe to the FinRadius USA to join our community of sovereign allocators taking back control. Math deletes institutional dependency. Stay disciplined, stay insulated, and trust the mathematics of real compound growth. We will see you in the next decoding breakdown.